Hello and welcome to the webinar today. My name is Alexandra Alvarado. I'm the Director of Marketing and Education at the American Apartment Owners Association. So glad that you could join us today. We have a very popular and time-sensitive topic to discuss with you all today. Some of you may have heard through our newsletter or maybe other media about the White House's plan to really target landlords, real estate investors through different tax policies. And Rick on the call with us today is going to go over what some of those policies are and how they may be affecting you, what you can do to sort of mitigate these potential new pieces of legislation. But before we get started, I just want to mention a couple of things. Tomorrow, we will be sending you all the full recording. So if you miss anything, don't worry, you'll be able to watch it tomorrow. And you'll also be getting Rick's contact information. So if you do want to schedule a demo with him, or sorry, a consultation, I should say, about what is, maybe a good strategy for you specifically, I would highly recommend you do that. And I'll provide that information tomorrow. We also will have a way for you to get a copy of Rick's book for free, which is really awesome that he does that, How to Retire from Real Estate. So stay tuned so you can get access to all of that. And we'll have Q&A at the end. I'm sure a lot of you will have questions. So definitely put those in the question box. We'll address those as they come in. Try not to put them in the chat box because it gets a little hard for us to organize which questions have been answered. The question box is way better for questions. So I want to tell you a little bit about Rick. He's spoken with us quite a few times and always has some really interesting information to share. He is an attorney, licensed real estate broker, and general securities principal specializing in 1031 exchange solutions. And he is co-author of the book, How to Retire from Being a Landlord. And before he transitioned into financial services, he practiced real estate taxation and estate planning. So that's a great background to have. Starting in 2006, he developed a retail division of Grubb & Ellis offering 1031 exchange solutions. He led capital markets team at Steadfast Companies that raised over $1.5 billion from individual investors to acquire over 100 apartment buildings. And he also created a new 1031 exchange program there for individual investors seeking to co-invest in REIT-owned properties. So 1031 Capital Solutions, 1031's in the name, but obviously Rick's expertise is way beyond that as well. So thank you, Rick, for coming on and talking about this. I'm super excited to hear more. And I think I'm going to sit back and take some notes myself because this is a lot, new things coming down the pike in the White House administration.
Well, thank you. And I appreciate Alexandra AOA and you particularly inviting me to be on these webinars. It's a great opportunity for us to interface with your members. And, this is always a great use of our time and more importantly, hopefully a good use of your time for the folks who are on this call. And I appreciate you saying that you're excited about this, this topic, although some of the subtopics I'm going to touch on, exciting is not the word. It's more like dreadful. But if I do my job, then hopefully by the end of this call, you'll at least have a better awareness of what some folks are proposing, and then we'll balance that with some reality on the likelihood of whether some of these proposals would actually become law in the near future. So it's, we're going to talk about what people are saying and then balance that with what could actually come to fruition.
Love it.
Again, thank you for having me. Before I get any further, I am required to tell you that this presentation is not a solicitation. Real estate and real estate securities may not be suitable for all investors. The risks of investing in real estate programs are no less than the risks of direct real estate ownership. Investing in securitized real estate programs typically involve higher fees than traditional investing. As in traditional real estate, there are no guarantees as to principal or income. And although the name of our company is 1031 Capital Solutions, we do not give tax or legal advice. A little bit more about us, my office is in Lake Oswego, Oregon. My partner, Jason McMurtry, is down in San Diego County. And we have satellite offices in San Francisco and Seattle, as well as team members who work remotely in San Antonio, Denver, and Orange County. I am an attorney by trade, as Alexandra mentioned. Jason has an MBA, and we both have been working in this industry together since 1998, which is crazy to me to think that we're now a quarter century into doing this work. I encourage everyone to visit our website, 1031capitalsolutions.com, where we have copious articles, blogs, videos, and educational content. And you can learn more about us and what we do there. In a nutshell, we are a financial services firm that exists for the purpose of helping individual property owners retire from being landlords. And on that note, in May of 2020, we published a book on this very topic, which is available in both print and electronic formats on Amazon. However, if you go to our homepage, you can easily find a link where you can order a free hard copy of the book delivered right to your door, and we encourage you to do that. If you have any questions about anything you hear today, or if you are considering selling a rental property and you want to discuss replacement options, you are welcome to schedule a call at your convenience on our website. Oftentimes, the topics I'm touching on these AOA webinars are subject matter where I'm sort of just touching the surface on topics that I could spend hours talking about in each instance. Today's a little bit different because I'm going to be touching on proposals where the proposals themselves are superficial, that there's not a lot of meat on the bones, and this is as much politics and posturing as it is policy. And so some of the topics I'm going to talk about, there isn't much beyond that, and because we don't know what people really have in their head in terms of these proposals that are being made. And as we'll see, some of these proposals are more for show than not. But having said all that, to the extent that I can illuminate in these topics, as Alexandra mentioned at the outset, please feel free to submit a question on your computers, and we will take a stab at answering as much of those questions as we can in the time that we have. So let's get started with talking about the tax changes that the White House has asked Congress to pass in 2023. And with varying degrees of specificity, the White House has proposed changes to the following categories: 1031 exchanges, capital gains taxes, income taxes, corporate taxes, Roth IRA limits, estate and gift taxes, and oil and gas. And again, there's more details or less details depending on the topic. We also are informed by prior proposals from the prior Congress. And so we in many of these instances have a pretty good sense of what some of the folks in the administration would like to see happen if they could wave a magic wand and push through some of these proposals. And again, we will balance this with the reality of the composition of Congress and the opposition, thankfully, that would be in place depending on the proposal. So let's start, of course, with 1031 exchanges. As I'm sure most of you know, a 1031 exchange is a real estate transaction in which you sell a rental property and replace it with another real estate investment without having to pay capital gains taxes. Tax-deferred exchanges have been around since 1921, over 100 years. And under rules going back to the 1990s, to complete a successful 1031 exchange, you just have to follow a few basic rules. And these rules include: one, you must have a qualified intermediary hold your sales proceeds which is essentially a specialized escrow function. 2, you must replace the entire value of the property you sold. And 3, you have to identify your replacement property within 45 days of selling your relinquished property. And there are a few extra details, but frankly, that's the extent of the complexity of the basic rules of actually completing a 1031 exchange. And if you sell a highly appreciated rental property, you have a qualified intermediary, you replace its entire value with a new property, and you identify it within 45 days, you have the ability under the law to completely defer all of the capital gains taxes that you otherwise would have paid in that transaction, but for doing the 1031 exchange. Further, if you follow these rules, you can continue doing 1031 exchanges over the remainder of your life and actually never pay the capital gains tax. And this is known as the swap till you drop plan. And it represents one of the few remaining legitimate tax management strategies for middle-class Americans to actually save for retirement and ultimately build family wealth. Now, in 2021, the White House proposed to limit the amount of capital gains tax that, the amount of capital gains that a married couple could defer under a 1031 exchange to $1 million per year. In other words, under the proposal, if you were to sell a property or properties and your taxable gain exceeded $1 million as a result of selling that property, even if you completed a 1031 exchange under the proposal, you would owe tax on any gain that exceeded the $1 million limit. For single people, by the way, the proposed limit was $500,000, and we do have plenty of clients who are single because they happen to be just single, or they're divorced or widowed. And so then for them, the tax consequences would be even worse. So this proposal in the prior Congress, in the first half of the Biden administration, went all the way through the process, and thankfully at the end did not end up coming out of committee in any meaningful way, and certainly did not end up in the legislation that was ultimately passed to basically deal with the budget situation in the first half of the administration. So we saw an attempt to limit 1031 exchanges that went far enough along to get a lot of attention, get a lot of commentary, create some grief, but ultimately failed. Today, however, the White House is proposing to eliminate 1031 exchanges altogether. So whereas the prior version of this attack on 1031 exchanges was to chip away and to limit the amount of deferral, now the White House is proposing to just undo an entire century of tax law and, again, eliminate 1031 exchanges altogether. Let me touch on how disastrous this proposal would be. According to a 2022 study by Ernst & Young, in the year 2021, 1031 exchanges supported 976,000 jobs and $48 billion of labor income. 1031 exchanges generated $97 billion in value added to the United States GDP. And taxpayers who engaged in 1031 exchanges, along with suppliers and related consumer spending, generated $13 billion in federal, state, and local taxes. When you factor in the tax increases I'm going to discuss here momentarily, selling a property without a 1031 exchange could trigger combined taxes in excess of 50%, especially in states like California or Oregon that have a high income/capital gains tax rate. Anyone facing a 50+% combined state and federal tax is almost certainly going to lean towards holding rather than selling appreciated property. And without 1031 exchanges, the open real estate market would just freeze. Values would stagnate, literally millions of jobs would be lost. So for all these reasons, and the fact, as we all know, that the pro-real estate lobby is very influential in Washington, D.C., I'm happy to report that we are not losing sleep over 1031 exchanges going away, at least not during this upcoming Congress. However, let's imagine a scenario where the anti-landlord crowd ends up with control of the White House and control of the Senate and control of the House of Representatives. It is possible that you could complete a 1031 exchange this year or next year, but later be forced to pay taxes when you want to liquidate your replacement property because the option to do a tax-deferred exchange has been reduced or eliminated. One strategy that we employ to mitigate this risk of future erosion of 1031 exchanges is known as the 1031/Upreat option. And on the resources page of our website, under the literature menu, we have a great educational brochure that explains how you can 1031 exchange your rental property today and then end up owning interests in a real estate investment trust or REIT down the road, even if 1031 exchanges are eliminated in the near future. And you do that on a tax deferred basis, meaning a 1031 today, followed by a tax deferred transfer of that property that you bought or GST interest that you bought, converting into a REIT on a tax deferred basis that allows you at the other end of the strategy to own interest in a REIT that again you can hold on to for the rest of your life and not be subject to taxes as long as you aren't making any withdrawals from that particular real estate investment trust. We also have an extensive video series that you can access on our website or on YouTube. So there are strategies designed in and around the possibility that that a future combination of a White House and congressional composition could successfully monkey with 1031 exchanges. It is a remote possibility. Let me emphasize again, we do not believe that Congress today or in the near future would actually pass a law to eliminate 1031 exchanges. But there are some folks out there who have targeted the 1031 exchange. And we did see 5 years ago that Congress did pass a law to reduce the scope of 1031 exchanges to just real estate. And some of you may not even be aware that this happened because most of us on this call really only care about tax deferral of real estate in the first place. But up until 2018, you could exchange cattle for cattle or farm equipment for farm equipment or an airplane for an airplane and utilize 1031 exchanges to defer the taxes that you would otherwise pay. Today, the 1031 exchange capital gains tax deferral benefit is only available when you're selling rental property and or business real estate and then buying other investment real estate. Okay, so to recap, 1031 exchanges was being proposed. Worst case scenario, just eliminating them altogether. Likelihood, it will not be touched, especially with the current partisan makeup of this Congress. So with a name like 1031 Capital Solutions, obviously we're sensitive to what's happening with the exchanges, but we are not worried specifically about the capital gain being deferred in a 1031 exchange in the near future. All right, next topic, capital gains taxes in general. And so let me start by reminding everybody where we are today in terms of how capital gains are taxed outside the context of a 1031 exchange. And today, if you pay capital gains tax upon the sale of real estate, in all likelihood, the sale of real estate outside the context of an exchange is going to push you into the tax brackets that I have on the screen here. And that is that you will be in the 20% capital gains tax bracket for your appreciation on your real estate, and in the 25% category for depreciation recapture. And I know some or most of you on this call fully understand appreciation versus depreciation, but just as a quick primer, when you sell real estate, the difference between your sales price net of the transactional expenses and what's known as your cost basis is your appreciation, and that's all capital gains, and you are taxed on that entire realization of capital gains. However, from an IRS perspective, there are a couple different categories of that capital gain. Some of your capital gain comes from just good old-fashioned appreciation, meaning that your property is worth more today than it was in the past. But for many of you, a big chunk of your tax bill comes from the fact that you've been claiming depreciation deductions every year. And for residential real estate, that's typically 3.6% of the original value of the improvements on your property. And so over a 10-year period, you will have claimed more than a third of the value of the improvements on your property as a deduction, and the IRS wants its deductions back when you sell your property and don't do a 1031 exchange. So that's why technically there's these two sort of sub brackets of capital gains taxes. Then a few years ago, the federal government tacked onto capital gains taxes the 3.8% Obamacare tax. So again, when you sell appreciated real estate, your tax consequence is a combination of a 23.8% tax on your appreciation and 28.8% tax on the depreciation you claimed along the way, which puts you somewhere, for most people, somewhere around a 25-26% blended federal tax rate on your capital gains. And that doesn't include the state taxes that you may be subject to, for example, in California or Oregon. Now, the proposal that the White House has sent to Congress would be to first increase the Obamacare tax to 5% for folks with incomes over $400,000. And by the way, when you sell real estate and you don't do a 1031 exchange, then the capital gains that you realize in that year, that kicks you up to these high tax brackets. And so that's treated as income. And that's why for most people with property that you've owned for a long time in California or anywhere on the West Coast, just on average, the appreciation is going to be such that realizing that gain almost always is kicking people into the highest tax brackets for that year because of the fact that they've realized such a huge amount of gain from the sale of that property in that year. So we would see an increase from 3.8% to 5% on the surtax. We would see an increase in the top capital gains tax rate up to 39.6%. Again, that would be from what's currently a 20% top bracket on capital gains today. So almost doubling the highest capital gains tax rate. So you combine those two, and for folks not doing a 1031 exchange, or even worse, folks who can no longer do a 1031 exchange because of a change in the tax code, the total federal capital gains tax under the current proposal would be 44.6%. Which of course is just absolutely crazy. So, and then again, you add the state tax and another 10-12% on that, and you are in the mid-50s% on your capital gains tax. But that's actually not the worst part of all this. the White House also is proposing to eliminate the step up in capital gains taxes at death. Again, I know most of you are familiar with this, but please allow me to give a quick overview on the step up in basis. And this relates back to the swap till you drop strategy that I mentioned earlier. So for most of our clients and most of the mom and pop landlords who have reached a point where they want to get out from directly managing their rental properties, they're looking to get into a more passive investment, whether that's some single tenant triple net lease property or the types of programs we offer. Typically, the strategy is to continue to do 1031 exchanges over the course of your life. Like I mentioned earlier, you keep kicking that tax can down the road, and then when you pass away under current law that's been around for decades, when you pass away with highly appreciated real estate, the capital gains tax that you would otherwise be subject to is eliminated at your death. And here's how this works. Like we just talked about, while you are owning real estate and continuing to do 1031 exchanges over time, the value of your real estate hopefully is going up while the cost basis is going down because of depreciation deductions. And you've got this growing capital gains tax liability because your cost basis is small and the property value is high. And if that property was sold, you'd be taxed on the difference between this shrinking, what's called the cost basis, and the actual market value of the property at sale. Under the step up in basis rule, when you pass away, the cost basis, which is the determining factor in how much gain you have to realize when you sell the property for tax purposes, that cost basis is stepped up, is the accounting term, to whatever the market value of your property is on the day that you pass away. And this same principle applies to other assets as well, like stocks, for example. And so if your family inherits any kind of real estate that you own and then turns around and sells that property right after you pass away, then effectively there is no capital gains tax for your family because the cost basis of the real estate has now been stepped up to whatever the value was when you died. And if they sell the property at that value, there's no capital gains to be realized. And again, this is a principle that goes back decades. Some politicians continue to characterize this benefit as a loophole for the wealthy. And please, let us all agree that any tax that requires you to die is not a loophole, okay? To argue that this is a loophole that's benefiting people today that they actually don't benefit from during their lifetime, to me is a gross exaggeration, because you do have to pass away in order for this capital gains tax to be wiped away. Now, we have a whole different set of laws regarding estate taxes that are designed to capture and redistribute people's wealth when they pass away, and we'll get to that topic. But there are folks out there in Washington, D.C. who really covet this tax deferral and have made a political point of especially specific to the step up in basis as wanting to close this supposed loophole, even though this is a well-established tax law that goes back decades. This proposal, by the way, would not only force a tax burden on your heirs, but it would also force many families to have to sell assets to pay for the taxes. So again, instead of having a continuation of this basic tax principle of having a capital gains tax be indirectly wiped away because of a step up in basis at death, what the proposal from the White House would say is that there would be no step up in basis. And so the cost basis of the property that you bought 30 years ago would continue to be the cost basis of that property for your children. And when they go to sell the property, either at the time of your death or sometime in the future, then when that property is sold, they're going to have to pay the tax on the difference, not between the value from when you died, but between the sales price and the value 30 years ago when you bought the property originally. And that seems incredibly unfair to a lot of us philosophically, to have to pass that tax burden on to your heirs. And not only that, to create a situation where people might have to sell the property prematurely to pay a tax if one of the ideas goes forward that tax could be due and payable sometime shortly after you pass away, even if the property isn't sold. It's a massive tax disaster from an estate planning perspective. And because of that, I don't think it's likely that this proposal would become law during the current Congress. But it's clear that some key Washington politicians, again, have made the step up in basis a real target. And we can expect to see this issue pop up again in future budget negotiations. So I really try not to get partisan, and I really like to focus on policy more than politics, but this subject has become a political football, and you should pay close attention to this, especially for folks who have estate plans that would be sensitive to this topic, because there are people who want to add a massive tax consequence to you passing on highly appreciated property to your family. Okay. The next topic is income taxes. In line with what I just talked about with increasing the top bracket for capital gains taxes from 20 to 39.6%. That same number has also popped up as the proposal from the White House for the top personal income tax rate. So again, for any folks making over $400,000, we would see under the proposal an increase from 37 to 39.6%. I will say that with the slim Republican majority in the House of Representatives, they may not be able to prevent an increase in the top income tax bracket, based on the current political winds. And so, unlike 1031 exchanges, which I think are almost completely safe right now, I would not be shocked to see that that we could end up with a budget package by the end of this year that includes an increase in the top bracket for income taxes. Now, with regard to corporate taxes, and again, some of you may not be as concerned about this, but many folks either have corporate businesses themselves or invest in corporate businesses, so it is something that touches the landlord community. The Trump 2017 corporate tax cut will get significantly rolled back under the current proposal, bringing the top rate up to 28% from the current 21%. That's a jump of a third over the current top corporate tax rate. The proposals also would increase the taxes that U.S. companies owe on their foreign earnings to 21%, which would effectively double the 10.5% rate that was included in the 2017 tax law. And this may seem obscure, but the proposal would eliminate the ability of hedge fund managers to pay the more favorable 20% capital gains rate on their profit participation income that would otherwise be subject to the 39.6% top individual income tax rate. And these managers will want to maintain their after-tax income, which means that if if Congress successfully, or at least the White House successfully, imposes a higher tax bracket for these hedge fund managers on their profit participation, who's going to end up paying the difference, so that those Wall Street guys can keep their after-tax income? It's going to be all of us who invest in these types of funds. So the trickle-down effect of these measures hits us indirectly in ways that some people don't necessarily appreciate when they read a headline that doesn't seem like that affects us. And oftentimes when you scratch the surface, you'll find that many of these proposals, even though they are targeting what seems like an elite or obscure demographic from a tax perspective, that these proposals end up having impacts that find their way to all the rest of us. Now, when it comes to Roth IRA limits, there's not a whole lot of meat on the bones with respect to this proposal. I don't have many more details to report, but I can tell you right now that the current proposal would limit the amount that taxpayers over right now the proposed $400,000 income level that they could hold in Roth IRA accounts. And but I do know that many landlords and real estate investors in particular, have not only large qualified accounts, but large Roth accounts. And for political reasons than anything else, this is another hot button, because there's been a few headlines of people who've been able to do Roth rollovers and supposedly evade taxes that they otherwise would have paid. And so let's go after people with high incomes and go after their Roth accounts. And I think this falls under the category of throwing a lot at the wall to see what sticks. And I would hope that there's not a whole lot of political momentum to erode anything that has to do with IRAs and Roth IRAs, which are a critical part of, for all of us, of our retirement planning in this country. There have been, on the other side of the equation, from last year, some good benefits with regard to limits and changes with 401ks and IRAs. But this proposal is designed to, again, be under the category of targeting the wealthy who are utilizing these supposed loopholes to manage their taxes. So in terms of likelihood of passing, this one has a big question mark on it, mostly because there aren't a whole lot of details behind this proposal. All right, estate and gift taxes. As you may know, for 2023, the lifetime gift tax exemption is just shy of 13 million. It's actually 12.92 million, but let's round it up to 13 million. This means that if you give up to $13 million in gifts over the course of your lifetime, and including upon your passing, that you can do so without ever having to pay gift or estate taxes. So it's kind of a comprehensive limit of gift and estate tax. And as long as you have not gifted more than $13 million combined over your lifetime and at death to your heirs, then under current law, you are not subject to any kind of estate or gift tax. And of course, for married couples, you can double that amount with proper planning. And so as a married couple, you can actually pass on $26 million of assets without being subject to tax. If you exceed the limit, the federal death taxes can be up to 40%. Now, some of you probably remember when back in the day when I started off as an attorney, and as Alexandra mentioned, when I was doing estate planning back in the day, the lifetime exemption was $600,000. And so virtually anybody who owned real estate especially on the West Coast, was by default subject to federal estate taxes. And even worse, the estate tax back then got as high as, I remember, 55%, I think was the top tax bracket. So this is an area, admittedly, where the current state of the law is much better than it was back in the day. And $13 million exemption clearly covers far more people than the $600,000 exemption. And as a result of that tax law change from several years ago now, most middle class and upper middle class folks, thankfully, no longer had to worry about an estate tax or death tax upon their passing, or with respect to any gifting programs that they had along the way. But because of the fact that we have been in that situation, and that some politicians recall the days where there was this very low estate tax exemption amount, on the other side of the philosophical spectrum, there are folks who look back at that time as the good old days from a tax revenue perspective, and continue to propose that the estate tax limit be reduced, that the gifting programs that many people employ to mitigate estate taxes be restricted, and really view estate and gift tax laws as an opportunity to go after more affluent Americans. And so I could see the possibility of some changes to the upper end of the tax spectrum happening during this Congress. Especially if you have a larger estate, you will want to pay closer attention to this issue over the coming months, because this tax the rich mantra eventually is going to touch some aspect of the tax code. And I think if you were to pick an area that had a greater likelihood of some folks on the right defecting and conceding some area of tax change, the estate and gift tax area, I think, is a likely candidate. So this would fall under, categorically for me, a possible tax change that we could see in this Congress. Hopefully not, but realistically speaking, this is something you're going to want to pay attention to. And then the last general category, again, of the topics that have been proposed by the White House, recently in proposing a budget plan to Congress, is oil and gas tax law advantages. So to put this into context, decades ago, as a matter of securing our national energy resources, Congress created tax benefits to encourage oil and gas drilling programs. And under current law, investors in a drilling program can deduct both intangible and tangible costs incurred by the drilling program that they're investing in. Intangible drilling costs are expenses that are necessary to prepare wells for production, but ultimately have no salvageable value. And we call these IDCs, intangible drilling costs. And IDCs include things like wages, fuel, chemicals, hauling, supplies, ground clearing, repairs, et cetera, et cetera. In other words, what intangible means, which is work and effort that goes into a drilling program that's not going to be left behind that can be taken out of the ground and put somewhere else. Well, approximately 60 to 85% of total drilling costs fall in this intangible category. And IRS regulations allow folks who invest in drilling programs to deduct 100% of these IDCs against their income in the first year that they invest in a drilling program. And that, of course, is a significant benefit, again, that was put in place specifically to attract investment so that the oil and gas industry could always rely on capital, investment capital, to propel the drilling projects happening across the middle of the country. Tangible drilling costs, by the way, or TDCs, are the components of a well that do have salvageable value. This includes certain heavy equipment, casings, pump jacks, wellheads, etc. And IRS regulations allow investors, again, to deduct 100% of the TDCs, but they can only be deducted over a 7-year period as opposed to in the first year. And the extent to which an investor can deduct IDCs or TDCs from their income really depends in part on whether the investor is a general partner or a limited partner. So, there are, as in a lot of things, devil in the details on the structure of these investment programs, but this has proven to be overall, in terms of a strategy to encourage investment capital, a powerful way for the companies that put together drilling programs to bring in capital from investors around the country on the basis that, yeah, you're taking considerable risk investing in oil and gas, but at the same time, you are getting a special tax benefit of getting to deduct these intangible and tangible drilling costs against your income as an investor. Well, despite the lobbying power of big energy companies, the hydrocarbon industry clearly has a PR problem, and it is conceivable that any tax advantages associated specifically with oil and gas, as opposed to green energy programs, frankly, could be harder to defend for many politicians in future years. And so I suspect that these tax benefits are going to be safe during the current Congress, but down the road, as public opinion changes, as the green energy movement continues to gather support, as people continue to become more sensitive about global warming, and to the extent that the traditional oil and gas industry continues to be demonized, rightly or wrongly, there is a greater possibility that some members of Congress will feel less motivated to defend tax benefits that are designed to encourage more oil and gas drilling. And so while this has been, for a lot of people, a really important tax slash investment strategy in taking advantage of these unique tax benefits for investment programs that aren't applicable for other types of investment programs, it is possible that, again, not in the next couple of years, but down the road, that we could start to see these tax advantages be chipped away, if not removed entirely. So again, not terribly likely to see a major change in tax benefits for oil and gas investment programs now, but something you're going to want to pay attention to if you are someone on this call who has invested in any kind of energy programs in the past and was thinking about continuing to do so in the future. So let me conclude by saying that despite the popular myth that business owners and landlords somehow pay little or no taxes, everyone on this call knows that the few remaining tax advantages for owning real estate and passing appreciated assets to our heirs, really are the only hope that most middle-class Americans have of achieving, any degree of wealth accumulation for their retirement and, more importantly, for their families. And if we are not continuously vigilant about our rights as taxpayers and property owners, there are people waiting to erode those rights at every turn. And nothing could make this point better than the very real proposals that we discussed today. So with that, Alexandra, I'm happy to take a stab at answering questions. Before we do that, though, we wanted to give you an opportunity to request a free copy of our book. And so if you would like to get a copy of the book, please check the yes button here, and then AOA will forward us your information so that we can get the book out to you.
Yes, so I'll leave that up for a little longer. Thank you for going through all of those. We do have plenty of questions. I'm going to start here in the question box. Charles asking, has the 45-day identification period for landlords in Los Angeles County been temporarily changed to October 16th, 2023, due to the declaration of Los Angeles County being named a disaster area? Do you know anything about any changes in Los Angeles County or California?
Yes, and I'm happy to address this subject offline with anyone who wants to explore whether their property could be subject to some relief. So let me say this, because it's complicated, but I did mention the hard and fast 45-day identification rule that I think most of you are aware of. And as I always say, it doesn't matter whether that 45-day deadline lands on, Christmas or New Year's or Super Bowl Sunday. There's no excuse. If you fail to put on a pen to paper and fill out the form to identify your replacement properties by the end of the 45th day from when you closed, you are out of luck and you cannot complete a 1031 exchange. But there's a big caveat to that. And occasionally the IRS, or by executive order from the White House, will issue specific relief to the 45-day rule and the 180-day rule for actually completing your exchange. And these are based typically on some kind of federal disaster. And not to go too far off topic, but when COVID hit, there was actually a nationwide extension for all 1031 exchanges for a period of time. That was unprecedented. There's never been a nationwide disaster that allowed 1031 exchange identification or closing deadlines to be extended. But this particular extension that the caller mentioned, the participant mentioned, there's a list of areas where, based on the weather and the flooding that's happened this season, where the IRS is allowing folks to delay the identification of replacement properties. I think there's also extensions for the completion, and but it's very date specific and location specific. So the short answer is yes, there is a relief, and whether it applies to you depends on closing dates and location. And there's a very detailed memo from the IRS on this topic. And again, if you go onto our website and schedule a call, we are happy to get on the phone with you and talk to you about your specific property and determine whether you are, whether this extension might apply to you.
Yeah. And really, for any sort of more customized sort of consult, if you want to say yes here, I can go ahead and connect you with Rick and his team after the call. So Michael asking, I have a rental home on a large lot. If I subdivide and sell off the vacant half of the land, is there any means to reduce my capital gains tax? I intend to use the proceeds on improvements to our residence and to the rental home itself, but the majority will be retained as cash.
Well, Unfortunately, it is not possible to sell a property. By the way, it's entirely proper and possible to sell under the scenario you described, to reparcelize and sell a vacant property that had been held for investment purposes and do a 1031 exchange. That's a no-brainer. But the problematic part of what you're proposing, if I understand you, is then wanting to essentially reinvest those proceeds back into real estate that you already own, and that you cannot do. Unfortunately, you have to reinvest in real estate that's new to you, and not merely take those proceeds and invest in, even if the other property that you have qualifies as investment real estate. The self-dealing of basically selling a property and then giving the proceeds back to yourself, that is not available under current 1031 exchange rules.
Okay, and also a couple of questions here on the estate and death taxes. Can you avoid all estate and death taxes by giving to charities in your will?
Well, theoretically, that is possible, and so on a completely different topic that I've done webinars on, and I would love to talk to you about again offline. You know, there are, for example, just the classic charitable remainder trust strategy. This is a highly effective way to not only move assets out of your taxable estate for estate tax purposes, but also to achieve significant income tax deduction benefits during your lifetime and convert highly appreciated real estate into an income stream. And usually this is done in conjunction with an irrevocable life insurance trust that is designed to replace the value of the real estate that you've actually, removed from your estate, so that your heirs can still end up with the benefit of the original asset value. But for estate tax purposes, there are some tried and true methods for avoiding estate taxes or reducing estate taxes by taking assets out of what would otherwise be your taxable estate and providing some kind of residual value of those assets to a qualified charitable entity. And there's all kinds of tried and true tax law and strategies behind doing this. And like I said, this is something we've addressed even on prior AOA webinars, and I'm happy to go into more detail with you on the phone if you'd like.
Great. Alexis asking, what can you say about spendthrift trusts to shelter capital gains? Does it work, and what are disadvantages?
Yeah, I think we've got sort of a mix-up of terminology here. So I tell you what, with regard to the spendthrift clauses of a trust and how that relates to a capital gains tax benefit, I wouldn't want to go down that path in the minute we have left. But again, please reach out to me, and I'm happy to have a discussion on what your trust and the terms of your trust are, and to the extent, again, without giving tax or legal advice, we could explore what kind of capital gains tax deferral benefit there might be as part of your estate planning. But anyhow, that
it's a big topic for another day. Rick, do you have a hard stop? Do you need to head out, or do you have time to maybe take some additional questions?
I am happy to take some more questions.
Okay. All right, everyone. If you do need to leave, I understand, but we are going to go through some additional questions. I will be sending you all the recording tomorrow. So if you missed the next segment of Q&A, you can catch it on the recording. We do have some really great questions. So let's see here. Let me grab a couple more. Do yearly gifting amounts apply against the estate exclusion limits?
And this is an area where I think the administration might be wanting to chip away at some of the traditional planning that many of you have done and that I've advised clients to do back when I was doing a lot of estate planning work. So, Alexandra, to just put this into context, the traditional kind of just basic advice, especially back in the day when the estate tax exemption was very low, was to reduce your taxable estate upon your death by gifting today under what originally were a $10,000 per person annual exemption, and then it went, and then that exemption amount increased. But using the old conventional approach that some of you probably remember, if you had 3 kids and 6 grandchildren, and so you've got 9 people below you on the family tree, and you were in a position to be able to spend some money, liquid assets, without impeding your lifestyle and your retirement, then you could write a check every year for $10,000 each of these 9 family members, and that was the gifting limit. And then that $90,000, of course, is reducing your asset value, and you do that for 10 years in a row, and you've pulled $900,000 out of your estate that otherwise would be subject to estate taxes. So it was actually, you know, for folks who had a large enough estate to have an estate tax problem, but not so large that this wasn't meaningful, that this was an important way to mitigate future estate taxes through gifting. When the estate tax exemption rose to 13 million, frankly, doing incremental gifting of these amounts for the folks who would be subject to estate tax above a 13 million, or for a couple of $26 million limit, wasn't really enough to put a dent in the estate tax that they would have. Because now you're talking about someone that's got a 30, $50 million estate, et cetera. And so, you know, giving $10,000 a year to a handful of family members is less meaningful to those folks than it was to people back when we had the $600,000 estate tax exemption. So it is still available, and it is still possible to give gifts to family members without counting against an estate tax exemption. But this is an area that I think certain members of the administration again feel it falls under the loophole category, and they want to try to eliminate the ability of folks to mitigate at all their potential estate tax consequences upon death. So the strategy still exists. It's less meaningful than it used to be, and if some politicians have their way, it would be eliminated altogether.
Okay. Another question from Mitra: how quickly after death should the family sell to get the new step up?
Well, that's a great question. And so again, this really comes down to the type of asset that is being passed on to the next generation. And I will take this opportunity for a little softball question with regard to the types of investment programs we do, which is typically either DSTs or real estate investment trusts. When you invest in a passive real estate program where you are just along for the ride, you're just an investor, you're not involved at all in the operation management of the property, then when you pass away owning an asset like that, I'll take a DST for example, the fact that you've passed away owning a highly appreciated DST investment doesn't really impact your heirs' life in any meaningful way, because all that we're going to do upon your passing is just redirect the monthly income that's being generated by that particular investment to your trust or to your heirs. And so there is no immediate need for heirs to have to take action, because the fact that the heirs have now inherited this asset is not a burden in the physical sense, as opposed to passing on to your heirs a rental property, especially a rental property that you are actively operating and managing. And so you're the landlord one day, and then next day you're gone, and now there's this rental property that no one is actively managing, and your kids live across the country. And those are those nightmare scenarios that can create legal liability, create problems for the family, create issues for the tenants. And so an actively operated rental property is a really difficult asset to pass on to your family without creating headaches for everybody involved. And in those instances, usually, not always, but usually the family members are inclined to want to sell that property sooner than later, because no one wants to take responsibility for managing that property. And so this is a long-winded way of saying that when to sell a rental property after a parent dies to me is more a function of what is the impact of that asset on the lifestyle and the practical consequences on the heirs, more than any kind of financial consideration. But having said all that, under current law, when there's a step up in basis at death, even if you sell that property or the DST or the real estate investment trust, whatever it was, even if you wait a couple of years, in all likelihood, the appreciation that will have occurred in only a couple of years is still small enough where you're not going to probably do a 1031 exchange as a result, because the tax consequence in a short amount of time is relatively small. So I can't give you a specific answer on when is the best time to sell a property that you've inherited, but I can say that in most instances, the rush or the urgency to sell the property is really not based on financial or tax consequences. It's just based on what is the impact of owning that property on your lifestyle.
Yeah, definitely. I mean, if your kids aren't prepared for that, I know we get members who join our association who become what we call accidental landlords, right? And they ask us a lot of questions because their parents were handling, everything. And it's very difficult for sure. Some of them are up for the challenge, or they've been already preparing for it, but some of them just land with a rental property and they don't really know anything about it, and it does become quite difficult for them to, especially when they have multiple kids. So definitely a good point there on DSTs. That's a great option. Also, couple of questions here on the Upreat. Jacqueline asking, what is the cost basis on an Upreat option? Is it based on the original 1031 property?
Yes, it is. And so when you, under any 1031 exchange situation, whether you invest in another traditional property or a Delaware statutory trust, whatever it is that you're investing in as a result of a 1031 exchange, your cost basis in the new property is the same as the cost basis in the property that you sold, subject to perhaps any additional debt that you incurred, or, in other words, unless you've added more capital to the exchange through equity or more debt, then your cost basis is basically continuing on. Otherwise, for 1031 exchange purposes, if you were allowed to keep resetting your cost basis every time you did an exchange, the IRS would never be able to catch up on the taxes, notwithstanding the step up basis at death that we've been talking about. So, and you raise a really good issue, because a lot of folks don't realize that when they do a 1031 exchange, that tiny cost basis in the property that they've owned for 20 years, that's still the cost basis going forward. And in fact, oftentimes that cost basis is going to shrink even further because of any remaining depreciation deductions that are available for that property. Now, flash forward to the Upreat scenario where you've done a 1031 exchange into a Delaware statutory trust. You hold that property for 2 years. That property is absorbed by a REIT, and when the dust settles, you now own shares of a REIT. Technically speaking, your cost basis in that REIT is still the original cost basis of the property that you bought way back when. Again, subject to the adjustments and depreciation that you've claimed along the way. However, right now, unless the IRS changes things, my understanding is if then a few years later you go to sell your some or all of your shares in the REIT, that the depreciation recapture component sort of gets lost in the shuffle, because the way that the capital gain is reported by the REIT is just long-term capital gains tax. So my understanding is that for most people, if they do actually liquidate some or all of their REIT shares, down the road before they pass away, that your tax consequence might be a little bit milder upon that sale as opposed to a traditional real estate, because the depreciation recapture portion of that of your taxes, again, the tracking of that gets sort of lost in the process. But having said that, the swap till you drop strategy still applies, whether you follow the Upreat strategy or not. And so, I encourage clients to really look at that Upreat investment as the last place that you want to withdraw cash from, if you, for some reason down the road, needed access to liquid capital, because you have the opportunity to let that REIT investment continue to roll, continue to grow, and then upon your passing, get a step up in basis on that REIT investment, just like you would in a rental property. And to me, it's a shame to cash out shares of an asset that has an opportunity to get a step up in basis, especially when you'd be subject to considerable long-term capital gains taxes. So kind of like an IRA, where you've got levels or tiers of assets in terms of priority that you want to draw from if you need it, and at the bottom of the list would be an asset that would be subject to considerable capital gains taxes if you were to make withdrawals. But they're available, and that's one of the reasons people like the REIT strategy. Is unlike traditional real estate or a DST, you have the ability to fill out a form and request a withdrawal and take out $100,000, subject to tax, of course, but do that in a way that provides more liquidity that you can't achieve with a typical 1031 qualified real estate investment.
Yeah. And I think that just goes to show that there are pros and cons with every strategy. And it's really about determining like which cons aren't going to work for you, right, or which pros are definitely going to work for you, because you got to weigh both. Absolutely. Amir asking, what goes into that income over 400K? Do we add the capital gain figure to our AGI or taxable income?
Well, again, so in terms of the proposal, it's vague because the proposals were sent over to Congress in almost bullet point form, and so what ends up coming out of this in terms of legislation and then based on the legislation, actual changes to the regulations, remains to be seen. But just looking at current law, when you sell a highly appreciated asset and you don't do a 1031 exchange, then the realizing that gain is puts you in a higher tax bracket, because it's treated. Remember, capital gain is just a form of income. In fact, decades ago, there was no distinction between capital gain tax and income tax. It was just all kind of lumped together, and states still do it that way. For example, California, Oregon, it's when you are taxed on a capital gain, and that's just an income, a form of income. So a capital gain is a form of income. And so by virtue of realizing capital gain upon the sale of an asset, that will put you in a higher income tax bracket overall. And then the actual rate that you pay then comes down to, well, is that traditional income? Is it capital gain or appreciation income? Or is it depreciation recapture income? Those are tax rate differentiators, but it's all really just income in the broader sense. And that's why some people don't appreciate the fact that, because they normally say you normally make $125,000 a year as a couple, you're kind of in the lower to mid range from a tax bracket perspective, and people forget that they can in a single year be knocked up into all the highest tax brackets by virtue of of realizing gain on a property instead of doing an exchange. And then they've underestimated the tax consequence, because it's that year they're in all the highest tax brackets as a result of that income.
Yeah, and I think that's such an important thing to note, is that with the increase in home prices and, multifamily prices nationwide, although it is slowing now, it's still higher than it's, ever been. That 400K could easily be surpassed, even for, like you said, someone who may not have ever expected to go over it, just with the simple sale of, something small. So yeah, definitely interesting that a number and how many people it will affect in practice. We'll just have to see what happens with that. So I did receive another really interesting question from Tina, asking, do you know of green energy vehicles or anything that's similar to the oil and gas as a tax strategy? And she put solar greater than wind. So that might just be a side note.
Well, I have to admit to you, it is outside my wheelhouse to fully understand the tax benefits of investing outside of these kind of traditional oil and gas investment programs, which have been around for decades, and they sort of become templatized, and we understand how they work, these limited partnership type of investments. Having said all that, I know that there continues to be a trend to want to provide tax incentives to invest in green energy, and I think to be consistent across all different types of energy programs, it would make sense to me to have in the tax code to have these types of programs provide similar tax benefits, even though the structure of a wind project or a solar project is different than a drilling project. But some of the basic concepts of being able to invest in a program and deduct tangible or intangible project costs, they may not be drilling costs, but they could be other. I could see how that could end up becoming part of the tax code down the line.
I agree. I think it makes sense, right? I mean, to get incentivized to do that, if that's the way that we're heading, I don't see why that would. Yeah, I mean, it just makes a lot of sense to me. We'll see. Certainly, there are a couple more questions that I'm going to end with. There are more, but I think some of them maybe you've already talked about, or maybe would be best answered offline. So I'm going to send all the questions over to you, Rick, so you can review them after and see, who we didn't get to. But the last two questions are sort of related, from John and is it Jadalia? I hope I'm pronouncing that correctly. Given the discussion of rent control coming back to the Boston area, what are your thoughts or strategies? On a similar note, Dalia asked, given vacancy tax, rent control, California state tax, and other such challenges, which states do you see most people 1031 exchanging into? So, there are a lot of new laws at the state level. We've talked a lot about the federal ones. What are you seeing on your end on the state level?
Sure, and I'm going to use the 1031 Delaware statutory trust market as kind of a microcosm to help illuminate that question. so because we have the statistics, we know when people are doing a 1031 exchange, where they are moving their money from and where they are moving to. And it is no coincidence from a tax and regulatory perspective that the two most popular states for folks who are selling appreciated real estate and reinvested in passive 1031 real estate programs, the two most popular states are Texas and Florida. And for a few reasons. Obviously, there's no income tax in either of those states. So, even if you are in an income tax state, you don't have to worry about, paying income tax on your real estate income in those states. Secondly, these are both states that are very landlord friendly. As I recall, Texas, I believe, and someone on this call can confirm or correct me, I think has a constitutional prohibition on rent control in the state of Texas, which is the opposite of California, Oregon, Washington, or Massachusetts for that matter. And so you've got environments where there's no income tax, where they are very landlord friendly states, very business friendly states. But then going even deeper, there are states, particularly in the South, the Southeast, where the demographics are favorable in terms of migration, population growth, job growth, the supply, demand, and ratio of rental housing. And so you add these factors together and you start to see these patterns, what we call relocating your equity, of folks selling highly appreciated real estate on the West Coast and in the Northeast, but increasingly, and I mean billions of dollars per year now, of moving their equity from their local area and investing through investment programs where the vast majority of the real estate is in that part of the country, in suburbs of Dallas or Nashville or Atlanta or Jacksonville or even Denver, where it's just a more favorable environment, not only to own real estate, but where the potential, at least, for continued net operating income growth, again, on a statistical basis, to a lot of people, feels more favorable than wherever they happen to own real estate today. And that's, we see the headlines, we see what's happening with real estate values, and the West Coast is having a tough time, where residential real estate in the Southeast continues to go up.
Yeah, and I think that's definitely what we've been hearing as well. Stella saying a lot of new multifamily developments in Houston. Yeah, that is, probably a great place to have those developments occurring. Although I have also read some reports of some places that have been a little bit overly developed, where now the supply might be tipping in the other direction. But it's helpful to do your research and find out which area is best for you. The advantage of like a DST, for example, is you don't have to put your eggs all in one basket. You could, have real estate, a piece of real estate in many different states. So that's also a really great strategy as well to keep in mind. And, with that being said, I think we're going to wrap this up. Thank you for staying so much longer and for answering so many more questions. Everyone, I'm going to send you the recording tomorrow along with Rick's info. If you said yes, that you want to book, I'll go ahead and send that list to Rick so he can get started. He does send an email book, but also a print copy if you want it mailed to you, which is awesome. Right. I love feeling a physical book, and that to me is just a better way to learn. But you have the option. Oh, it's blurred. Oh, there it is. There it is. Love it. So everyone, please take the exit survey as well as you leave. We are having a webinar next week if you are in New York about New York legal compliance, another Northeast state that has a lot of laws that are not so landlord friendly, and we have a lot more new ones to cover next week. And then the following week, we'll be talking about tech investments and tax strategies around investing in tech for your rental properties. So I'll send you those invites after the webinar and tomorrow as well. Anyway, thank you, Rick. It was fantastic as usual having you come and present. I'm getting a lot of thank yous in the chat, so well done.
Thank you. Thank you for having me.
Of course. Everyone have a wonderful day. Take care.
Bye-bye.
Bye.